Hello, and welcome to the Argyle CFO Summit, Strategic Finance in the Age of AI and Automation. My name is Michael with Argyle. It's great to have everyone joining us today. A couple of notes before I turn things over to our esteemed speaker. First, a quick reminder to stop by our sponsors' virtual booths at any time during today's event and for the following week. Our partners are committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which include complimentary materials and information. To ask questions throughout the session, simply type into the Q&A chat, and we will address your questions at the end of the session. Also, be sure to subscribe to Argyle on YouTube for exclusive access to all our past events. And now, without further delay, I'd like to introduce our speaker, Hina Agrawal, Chief Financial Officer with Duluth Trading Company. We're excited to have Hina with us for a keynote presentation titled Driving Financial Resilience Through Operational Discipline and Strategic Reset. Hina, thank you so much for being here today. Welcome. Over to you.
Thank you, Michael. Good afternoon, everyone. It is a pleasure to be here at the Argyle CFO Forum. Today, I want to talk to you about a journey many of us have faced, leading through a period of high stakes and macroeconomic volatility. I'm Hina Agrawal, and I joined as the CFO for Duluth 2 years ago. In addition to finance and accounting, I'm responsible for real estate, procurement, and IT. A little bit about the history of Duluth. Duluth started in 1989 as a workwear brand selling the Bucket Boss for workers to store their tools on their job sites in a convenient way. By 2001, it operated mainly as a catalog company with about 6 to 7 million in sales and grew rapidly over 100x to almost 700 million in sales by 2021. We are a direct to consumer business with online sales that make up 2/3 of overall sales and a retail footprint of 66 stores in the US. After 2021, the company made significant investments in infrastructure like logistics and technology, direct to factory sourcing, but faced headwinds from high inventory, heavy promotional discounting, resulting in higher costs and lower margin. In 2024, we had a net loss of 44 million and a free cash flow of negative 25 million. So fast forward to 2025. Coming into 2025, we turned around our results significantly. We improved free cash flow by almost 42 million to 16.6 million positive, adjusted EBITDA by 10.3 million to 24.9 million. We improved gross margin by 420 basis points to 53.4%. And at the same time, we reduced inventory by 35 million or 21% to 131.3 million. So how did the team at Duluth architect this turnaround? Coming into 2025, our turnaround playbook included 4 pillars. First was restoring price integrity, transitioning away from deep discounting. Second, operational discipline to get our inventory processes in the right place and connect to our financial goals. Third, macro agility and tariff mitigation. That's something we had to just like many of you come up with during last year when we had the tariffs being placed on many goods. And last but not the least is strengthening our balance sheet, modernizing our treasury function and our capital structure to ensure we had the liquidity to play offense and not just defense. So starting with the first pillar of restoring price integrity, we faced a perfect storm. Our brand was caught in a cycle of deep, high frequency discount. In 24, our Black Friday discount was 50% off across the board. And compounding this, in 25, we had 11 million in total tariff costs and a complex macroeconomic environment. To survive and then to thrive, we had to move from a volume at all costs mindset, and we had to put our faith and we had to be consistent throughout the year on a margin first strategy. The way we did that was First of all, you have to have the right level of inventory. Because we had a lot of inventory in the past that we bought, we made sure we implemented a new process called enterprise planning and open to buy, to make sure that the inventory we were buying was connected all the way through to the merchant goals and then to the financial goals. We reduced the depth of our offers. For example, in Black Friday, we went from being 50% off to 30% off and had some sweeteners like dam busters that we placed on certain products. In addition, to mitigate the tariff impact, we also had targeted price increases on some of our core products that had lower price sensitivity and elasticity. All these measures led to a gross margin improvement of 420 basis points. The next pillar that I will talk about is, sorry, I'm just trying to move the right slide, the inventory process optimization, which was a key enabler to managing our pricing and promotion strategy. And you cannot manage what you don't measure. So we launched this enterprise planning process that I talked about a little bit earlier that connected marketing and merchandising directly to supply chain and finance. In addition to that, we rationalized our assortment. So we got rid of a lot of things like swimwear that were not part of our core assortment and where we did not have permission to play. We aligned our receipts with the sales plans, especially also the timing of receipts, and we reduced our year-end inventory by 21% or 35.2 million. We also made sure the allocation was right. So I talked a little bit about investing in infrastructure and logistics early on. And so we made sure that the Adairsville DC, which is where we had invested our capital in a fully automated facility, that's where 70% of our inventory was positioned, and we were fulfilling almost 70% of our orders from that facility. Um, so, in addition to buying right, buying directly from factories, allocating inventory appropriately throughout our fulfillment center network, and reducing SKUs, and then managing and connecting all those dots through the enterprise planning process across different functions. We not only reduced inventory, but at the same time, improved our in stock in stores, especially during the peak season, by almost 500 basis points. The next key pillar for us was responding with agility to the macroeconomic conditions, especially tariff mitigation. So over here, I talked about the targeted price increases that we took on a portion of our portfolio that was less elastic. In addition, we also managed the receipt timing of inventory based on all the latest news we were getting on when different levels of tariffs were going to go into effect. We negotiated with our vendor partners to share in some of the cost, and we also executed cost reductions at headquarters, which ultimately enabled us to fully offset 11 million in tariff costs during the year. Last but not the least is cash and asset management. And this included a few different things. We optimized our logistics footprint. So we've consolidated our logistics network in the last 18 months from 4 fulfillment centers down to 2, and positioned our automated Adairsville facility at the core to make sure we are maximizing the investment we've made over there. On the retail side, we didn't just close stores, we optimized them. Every store in our fleet is profitable, and our retail channel delivered a 550 basis points margin improvement in 2025, in addition to a positive comp growth. So this was the first time in many years where we've seen that positive growth in the retail channel, driven by lowering our promotions and realizing that people who walk into our stores have a high propensity to buy and spend and invest in things that they consider core items in their closet, and are less concerned about the price discounts. And then, last but not the least, here we also managed our capital allocation. Um, in the past, we've had, in the history of Duluth, since Duluth went public in 2015, we've had a cycle of heavy investment as we were rolling out 15 stores a year for 3 to 4 years, and then followed by heavy investment in infrastructure, like the logistics network or technology. And so what we did starting in 25 is said, we are going to hold the overall capital at a certain percentage of sales, which is industry average, and then also make sure that we are allocating that capital appropriately between growth and infrastructure capabilities. So in addition to these operational functions, the last thing that we did was to make sure that we had access to cash. We orchestrated a successful transition to an asset based lending facility, which provided lower borrowing costs and greater flexibility. We ended the year with zero debt on that facility and a liquidity position of 141.3 million. And as a result, our free cash flow was 42 million better versus last year, um, giving us the true scorecard of a balance sheet where cash is king in these high stakes environment. To speak a little bit more about the turnaround is also required a cultural shift, not just in the overall organization, but also in the finance organization. A shift I called finance forward. We transformed the finance function from a transactional department into a strategic partner. We we positioned ourselves as a leading function with a growth mindset, and we said, we have, as a finance and accounting organization, we really have two key objectives. One is to be the unbiased, objective team player, but at the same time be an unapologetic steward of the company. And so, integrity of the numbers, integrity of everything we report, is of the highest importance, especially in times of high change. So there are three key things we did as part of the finance transformation to move to more value-added services. First was we introduced business partnership with embedded business finance partners for merchandising, marketing, supply chain, IT, and so on that sit with the business throughout the organization. The second is we outsourced a lot of the transactional work. There were things like sales tax that were being done in-house, so we outsourced that. There's fraud monitoring activity we've outsourced to the experts, and we've consolidated some of these outsourced functions. Um, Continuing on that strategic lens, we insourced functions like investor relations to make sure that we have a direct contact and direct conversations with our key investors. We also bolstered our treasury group by hiring a treasury expert into the group. So we've made a lot of these changes because these changes are essential to executing on our business outcomes. I'm incredibly proud of how our team has successfully delivered a business turnaround in a time of high volatility and responded with agility to that volatility. This has helped us establish a resilient foundation that can deliver sustainable, profitable growth. As we move into 2026, we will build on this strong base, characterized by a disciplined and promotional strategy, stronger operations, leaner inventory, and enhanced cash flow. Our focus will be on stabilizing sales through increased assortment productivity, ensuring healthy returns on our full funnel marketing investments, and strengthening our brand to retain valuable existing customers while successfully acquiring new ones. In closing, financial resilience is not just about cutting costs, it's about disciplined execution and aligning the entire organization towards a singular goal. At Duluth, that meant restoring the integrity of our brand and strength of our balance sheet. Thank you, everyone, and I look forward to your questions. I see we have one question here. When you talk about operational discipline, what are the most important habits or processes finance teams should focus on to build real resilience? That's a great question. And it goes back to what I talked about earlier, which is embedding finance leaders into the business and working in partnership with them so that you're not just the policeman, but you are helping the business achieve goals in a way that is objective and data based. I would say that is one key thing. That is from a people standpoint. From a process standpoint, we established in 25 clear operational KPIs that have a link to our financial goals. So in the past, we would have these engagement surveys where people would say that they, achieved all their goals, but the company was still losing money. So how is it that if you were individually achieving your goal, the company was not profitable? And so a key change we made in 25 was we went through in detail and made sure we had the top 10, 15 KPIs for the whole enterprise, and that everyone's goals, individual goals, were linked back to those KPIs, which then linked back to the financial goals. And then the last piece I would say is the enterprise planning process, which in is what we call it internally, but in industry terms, it's the integrated planning process or SNOP, which really makes sure that all different functions are talking to each other and communicating the same information and going off the same assumptions in terms of what our sales targets are, and we are buying inventory that matches with that. So it's a lot of connecting the dots across the enterprise that we focused on to build real resilience. There's a second question on in periods of uncertainty, how do you decide when to tighten controls versus when to continue investing in growth? This is a great question. This is a great question on how do you balance it. And so we have a base plan. I would say in 25 we had fewer opportunities to think about growth than we have now in 26. Now that we've built a stronger foundation, um, in 25 it was all about keeping the discipline. There were times, every time you see a daily sales report or a weekly sales report, if it's not in line, there is that nagging thought: should we go back to promoting, should we do this, should we do it's really critical that we stay on the path. And so in periods of uncertainty, especially, what we do on a regular basis, so in addition to our financial reviews, when we do report the prior month, we maintain a robust list of future based risks and opportunities, the probabilities, who owns them, what's the action to mitigate the risks, to capitalize on the opportunities, which gives us a better sense of what the outlook is. And if we have upside or downside, what we need to do. Do we need to tighten more controls, or do we have space to invest some of that upside into opportunistic growth areas during the year, aside from what was already budgeted? There's another question on what are some early warning signs that my company may need a strategic reset before performance starts to decline. Again, this is a great question. I think we focus a lot on the P&L. I would say um, things like the balance sheet and cash flow can give you some earlier warnings, especially if you think you're when you think about working capital and inventory. Coming at the end of 24, we had high levels of inventory, and that was a warning sign in terms of that, are we really going to be able to sell all this at the right price, or are we going to have to discount and use a lot of markdown money to do this? So I think looking at the integrated financial statements and not just focusing on the P&L, because it's easy to gloss over the balance sheet or cash flow. But there are some leading indicators in those financial statements. The other leading indicators are in the operational world, where you need to look at, if your brand awareness, your aided and unaided awareness, the customer count, how are those doing? What is your traffic looking like? What's your conversion looking like on the marketing side? Operationally, how much waste is in the system? So there are a lot of leading operational indicators, and that's why it's so critical to connect those KPIs, define those KPIs, and then connect those to financial statements. Because even during the month or during the quarter, those operational indicators can really be the leading indicators of what's happening on an ongoing basis. There's another question on, do you see financial resilience becoming more about adaptability and speed rather than just cost control and risk management? Absolutely. Absolutely. We live in a very uncertain world, and it's borne by 25, which all of us here have experienced. Um, Having a contingency and managing proactively with the business teams, giving visibility, transparency, and actively working the risks and opportunities, and adapting to those is extremely important. Not just from making sure our costs are in line and we are managing risks, but also that we are capitalizing on any opportunities that come forth and they don't just disappear because no one was necessarily actively working on executing them. If there aren't any other questions, I would like to thank Argyle for this opportunity and everyone for the great questions. And I will send it back to Michael.
Thank you, Hina. This was wonderful. It's a very good keynote, and we appreciate you being here. I also want to thank everyone else for joining us today. And finally, we want to thank our sponsors, Avalara, SAP, and Ramp. Now, this session, along with all of today's content, will be available on demand following the event. This officially concludes the Argyle CFO Summit, Strategic Finance in the Age of AI and Automation. Thank you again for joining us today and engaging in our content. We look forward to seeing you at our next Argyle digital event soon, which will be our AI Summit, Scaling AI for Impact, on April 30th. Have a great rest of your day. Thank you, Hina.
Thank you, everyone.